Welcome back to The Deep Dive, the only place you need to be to turn raw data into actionable knowledge.
And today, we've got a mountain of it.
A huge stack, yeah. We're looking at the latest reports from the North Texas Real Estate Information Systems, NTREIS. And we are doing a bit of a surgical strike on a market that is it's fundamentally defying all the expectations.
That's absolutely right. For anyone trying to buy or sell or even invest in North Texas right now, the national conversation is, well, frankly, it's often irrelevant.
Right.
You know, national headlines talk about this broad market stabilization, maybe a slight recovery, but real estate is so intensely local.
Especially here. I mean, we're talking about more than a dozen counties that make up this vast North Texas region.
Exactly.
So our objective today is to really cut through that noise. We're going to analyze the October 2025 data, and we're not just summarizing, we're deciphering what these specific local numbers, from median prices to months of supply, what they truly mean for your strategy.
And the overarching context, the big picture headwind.
It's the same story we've been talking about.
It's the same story all through 2025.
Yeah.
Persistent, elevated interest rates. This is the economic force that's shaping everything.
We talk about it so often because its effect is just not subtle at all. Those high rates create what we call the lock-in effect.
Right.
So if you, the homeowner, you locked in a 3 or maybe 4% mortgage a few years back, why would you sell? Why trade that for a new 7, maybe 8% mortgage just to move across town?
You wouldn't. It just doesn't make sense. And that inertia, that reluctance to move, it dramatically shrinks the available inventory.
Especially the move-up inventory.
Exactly. So most of the new supply hitting the market is coming from new construction.
Or forced sales.
Or forced sales, yeah. People who have to move, not people who are just willingly trading in their low rates.
Yeah.
This regional sluggishness is a completely natural consequence of that.
And we definitely see that general softening in the North Texas macro data, which we're going to unpack first. But here is the core mission of this deep dive. We are drilling down into a fascinating statistical anomaly. We're talking about Jack County.
Jack County is acting as a statistically significant outlier. While the overall region is showing slowing activity and it's struggling with increasing inventory, Jack County's data, it runs completely counter to that narrative.
It's a totally different story.
Its internal metrics tell a truly compelling story of a sort of localized demand explosion.
Okay, let's unpack this with context first. Before we get too excited about the Jack County numbers, we really need to appreciate just how soft the regional market is.
You need that reference point.
You have to have that reference point. And we always start with a quick national comparison using NAR data just to see how North Texas stacks up against the broader U.S.
Nationally, October was. It was relatively mild. It continued that trend of modest activity. U.S. existing home sales were up just slightly, about 1.5% month over month.
But year over year was a bit better, right?
A bit better, yeah.
Yeah.
Up 4.1% year over year, reaching a seasonally adjusted annual rate of about 4.06 million units.
That's a little bit of momentum. And the National Association of Realtors, they pretty much attributed that slight increase to mortgage rates falling a bit in October.
Right. They hit their lowest level in over a year.
And that gave buyers just enough breathing room to kind of jump back into the market.
And nationally, unlike what we're seeing in North Texas, the median existing home price continued its upward trajectory. It was up 2.1% year over year to $415,200.
And it's still the South and the Midwest driving that, right?
That's where most of that appreciation is coming from, yeah.
Okay, so now let's bring that back home. Let's compare that national picture of, modest gains in price appreciation to the North Texas region as a whole.
Right, using the NTREIS data for October 2025 versus October 2024.
And the region is showing these clear indicators of market softening that just completely defy that national trend.
The most direct evidence of that softening is the median sales price. Regionally, it's down 2.7% year over year.
So what's that in dollars?
That's a drop from roughly $370,000 down to $360,000. It's not a crash by any means, but it is a clear indication that properties are closing for less than they were 12 months ago.
And that's confirmed when you look at the year-to-date numbers, which are always good for smoothing out those monthly fluctuations. The YTD median sales price for North Texas shows a small but, persistent drop of 0.5%, stabilizing at $370,000 for the year.
And that confirms that the market as a whole has eased off those peaks we saw last year. It's stabilizing at a slightly lower, maybe more accessible price point for the average buyer.
And this leads us directly to the sluggish activity. If prices are softening, it implies fewer transactions.
Which is precisely what the data shows.
So how does that slow down in commitment? How does that manifest in the numbers?
Well, we look first at pending sales. These are the properties that went under contract in October.
The forward-looking indicator.
The crucial forward-looking indicator, yeah.
Mm-hmm.
And that metric decreased significantly by 8.7% region-wide. It dropped to 8,569 units.
Wow. So almost 9% fewer buyers committed to a purchase this October compared to last.
Exactly. And then closed sales, which, finalize those transactions, they also saw a modest decrease of 1.7%, totaling 9,324 units.
An 8.7% drop in pending sales that's substantial. That tells me that those high interest rates are really making buyers hesitant.
Or maybe they're just running out of affordable inventory to begin with, thanks to that lock-in effect we mentioned.
It's probably a combination of both.
It's likely a combination, yeah. Buyers are definitely hitting the pause button, they're reevaluating their purchasing power, and that reluctance is immediately reflected in the market speed.
Which we measure with days on market.
Days on market until sale, or DOM.
Okay, so let's unpack that increase. Regionally, it's up substantially, right?
It is, yeah. The regional DOM increased a solid 11.9% year over year. It rose from 59 days to 66 days.
So think about that. The average home now spends a full extra week on the market just waiting for a signed contract than it did a year ago.
Right. That means less competition, more time for inspection, and definitely more negotiating power for the buyer.
And the year-to-date figures tell an even starker story about this trend. The YTD DOM is up 16.7%, now averaging 63 days.
Which suggests that the environment of, quick, frenzied, multiple offers, that's effectively over for the vast majority of North Texas properties.
Sellers now have to be patient.
And that patience is costly. When properties sit longer, it usually leads to price concessions, and it directly affects the supply side of the equation.
How so? When the speed slows down and transactions decrease, what happens to the available supply?
Well, the supply side naturally expands because the rate of consumption, the sales, it isn't keeping up with the listings.
So inventory grows.
Inventory of homes for sale increased by 7.4%, climbing to 50,080 units across the region. And this is the critical metric, month's supply of inventory, or MSI.
Let's spend a moment on MSI because this is often the most misunderstood metric for listeners. What is the significance of the regional MSI rising 6.1%?
So MSI measures the theoretical time it would take to sell every single current listing if no new listings came on the market.
Based on the current pace of sales.
Based on the current pace of sales, exactly. Yeah. And regionally, it rose from 4.9 months to 5.2 months. A market is generally considered balanced, where neither buyer nor seller really has the upper hand, at about 6 months of supply.
So 5.2 months is still technically a seller's market, but it's pushing dangerously close to that 6-month boundary. That 6.1% rise means the market is rapidly adding slack.
Precisely. It confirms that inventory is growing faster than demand is absorbing it. And when supply outpaces demand, sellers have to work harder to close deals.
Which brings us to pricing pressure. If houses are sitting for 66 days and supply is increasing,
sellers are getting less of what they originally asked for.
Right.
Correct. The percent of original list price received dropped regionally by 0.8% year over year, settling at 93.4%.
And that might sound like a minor drop, but it means that for the average $360,000 home, the seller is conceding an extra $3,000 or more in negotiations.
Yeah, either through a price cut during the listing phase or through hefty buyer concessions, like covering closing costs.
Okay, so let's synthesize Section 1. The macro North Texas picture for October 2025 is defined by soft prices, slowing transactions, extended time on market, and rising supply.
All consistent with that high interest rate lock-in headwind.
That's the hesitant regional mood.
Yes. The market regionally is just holding its breath.
Now, forget everything we just said,
Right.
because we are pivoting hard to Section 2, Jack County.
Right.
When we zoom into this one area, we enter a completely different economic reality. This is where it gets really interesting.
It does. But before we celebrate these numbers, we must absolutely state the local market warning.
The fine print.
The fine print. Jack County is a low-volume county. Unlike Dallas or Tarrant, which handle thousands of transactions a month, Jack County's October metrics are based on a tiny handful of sales. I think it was only 5 closed sales this month.
So one big sale can skew everything.
Exactly. A single high-value ranch sale can violently skew the monthly median sales price.
So we have to treat the monthly data with extreme caution. We have to rely heavily on the year-to-date, the YTD data, to establish the actual sustained trend line.
Exactly. The YTD metrics, which track the entire 2025 story against 2024, they normalize that monthly volatility and give us the true picture of market momentum.
Okay. Regionally, pending sales were down nearly 9%. Jack County, though, it's an engine of activity. Let's start with the supply coming onto the market. Are sellers even willing to list there?
They absolutely are. New listings saw a substantial increase of 23.1% month over month. That's from 13 to 16, like a massive jump in seller confidence.
Or maybe an influx of new builds or land?
Could be. But the real story is the sustained trend.
The YTD.
The YTD trend is robust. New listings are up 24.4% for the year, climbing from 123 listings in 2024 YTD to 153 in 2025 YTD.
So inventory creation, people willing to sell despite the high rates, is a strong, sustained trend in Jack County.
And it's running directly opposite to the metro areas where that lock-in effect is limiting new listings.
So if people are listing, are people buying? Regionally, we said buyers are hesitant.
In Jack County, buyers are sprinting. Pending sales increased 25.0% month over month from 4 to 5. But again, the YTD pending sales figure shows this exceptional massive growth.
How much?
It's up a stunning 47.6%, moving from 42 units in 2024 YTD to 62 units in 2025 YTD.
Let's just pause on that. 47.6% YTD growth in pending sales. That is nearly a 50% increase in buyer commitment year over year.
Phenomenal.
That's phenomenal demand growth, especially in an area where the regional sentiment is flat or even negative.
That volume acceleration is the first sign that this county is in a high demand cycle. And closed sales confirm that massive absorption.
Even though the monthly number was a bit down.
Right, while the October monthly closed sales dipped slightly down 16.7%, the overall YTD closed sales are up a huge 44.2%.
From 43 to 62 units.
Correct.
So a 44.2% increase in closed sales YTD means that 19 more properties, 19 more families, investors, developers, successfully secured property in Jack County this year compared to last.
It's a staggering injection of buyer confidence and market activity that just completely defies the regional inertia.
The YTD metrics are crucial here. They show a market that is fundamentally accelerating its transaction velocity.
This isn't just a hot month. This is a hot year for Jack County, and it's driven by persistent buyer absorption.
Okay, now let's turn to price performance. Regionally, the median price was down 2.7%. What did Jack County's median price do in October?
Jack County saw a healthy monthly spike. The median sales price was up 8.9% month over month, rising from $257,500 to $280,500.
That is strong monthly appreciation, especially given the headwinds. But here is the statistical anomaly that requires some careful context.
That's YTD number.
YTD number. When we look at the year-to-date median sales price for Jack County, it remains perfectly flat, 0% change, holding steady at $300,000 for both 2024 YTD and 2025 YTD.
Right. And this flatness, despite the strong monthly spike, it suggests a few things. First, that 8.9% spike in October was almost certainly due to higher-end sales.
Those ranches or investment properties.
Exactly, which significantly boosted the monthly median. Second, the long-term price trend for the typical property in Jack County, that $300,000 property, has stabilized successfully. The market isn't seeing inflation. It's seeing massive volumes successfully absorbed at a stable price point.
So buyers are flooding in, but the price point is holding steady. That implies a high degree of affordability relative to the demand.
It does.
But if demand is accelerating this fast, the supply side must be under incredible pressure.
It is. And inventory absorption is the single most critical insight in this entire deep dive.
Okay.
Regionally, supply was up. In Jack County, inventory of homes for sale decreased 10.1% year over year, dropping to 62 units.
But that's just the raw number of houses. We need to look at the month's supply of inventory.
The MSI. And it dropped sharply by 34.0%, falling from a massive 15.9 months of supply in October 2024 down to 10.5 months in October 2025.
Whoa. Okay, that velocity is astounding.
A 34% drop in inventory supply velocity is enormous. This is the metric that should put Jack County on every investor's and buyer's radar.
But let's clarify what 10.5 months means. It still technically puts Jack County in a buyer's market, right? A heavily supplied market.
Yeah, it's still a buyer's market territory. If Tarrant County is at 3.8 months, 10.5 months is still a massive amount of slack.
So why is the 34% drop so significant?
Because it tells us that the historically massive backlog that defined Jack County as a heavily oversupplied buyer's market last year is finally being eaten away. And it's happening extremely quickly.
It's the rate of change.
It's the rate of change. It's like draining a massive lake Even though you still have a lot of water left, the rate at which the water level is dropping shows that underlying demand is creating significant structural inventory pressure.
So if this rate continues,
Jack County will be a balanced market within a year.
that is the ultimate sign of powerful underlying momentum. But now we have to address the major paradox in the data.
The days on market.
The DOM. If buyer absorption is so rapid, 44% YTD growth and a 34% drop in supply velocity, why did the days on market until sale increase dramatically by 42.3% in October, all the way up to a whopping 111 days?
That is the aha moment. It forces us to reconcile two completely contradictory trends. Robust sales volume and shrinking inventory should lead to a lower DOM, not one that spikes to nearly 4 months.
Okay, let's debate this. If inventory is shrinking and demand is growing, doesn't that suggest buyers will eventually pay the price, just slowly? Is this really seller overreach?
It's both. And this is the nuance that the regional average completely misses. The high DOM suggests two things are happening at the same time in October. First, that high YTD volume proves buyer interest is absolutely present.
No question.
But second, the 111-day wait proves that the price expectations of the sellers who listed recently are fundamentally misaligned with what buyers are willing to pay right now.
And we saw evidence of that. The median price jumped 8.9% in October. But if you look closer at the average sales price for October,
It jumped 79.9% month over month to $515,548
an 80% increase in the average price in 1 month.
on a small number of sales.
Oh.
But that tells the story. Sellers are aggressively listing high-value properties, those unique ranches, large land tracts, luxury custom builds at very aspirational prices.
So the average house is still selling stably at $300,000 year to date, but the high-end listings are coming on at these crazy prices.
Exactly. Buyers are interested in Jack County, but they're not willing to stomach massive appraisal gaps or inflated initial list prices.
So the result is these long, drawn-out negotiations.
Protracted negotiations. Sellers list high, buyers lowball, and the time taken to find that middle ground pushes the closing period out, spiking that DOM to 111 days.
The demand is there, but the price discovery process is just messy.
It's a market playing chicken, where buyers are absorbing available supply aggressively, but staying price sensitive enough to delay the sale.
That makes perfect sense. Jack County isn't slow, it's aggressively volatile.
It's a classic sign of a market that's rapidly transitioning from heavily supplied to constrained. The sellers are betting on future scarcity. And that 34% drop in MSI proves their gamble isn't without foundation.
That was a tremendous deep dive into one county. Now, before we generalize this rural momentum trend, let's zoom out to Section 3. We need to provide context for you, the listener, by showing how Jack County's volatility stacks up against the other counties.
This is a key section because it absolutely reinforces that the regional $360,000 median price is essentially meaningless.
It's an average of extremes.
Exactly. The North Texas market isn't just bifurcated, it's fractal. Every county tells a different extreme story.
Okay, so let's start with extreme price volatility. We're looking at counties with the most eye-watering year-over-year changes in median sales price for October.
Right. Jack County's 8.9% gain was strong, but there were some outright market explosions. Stevens County saw its median price soar an unbelievable 130.0% to $257,000.
130%.
Then you have Rains County, up 88.8% for $389,950.
A nearly 90% price jump in Rains County is extraordinary. What does that do to a local market?
It creates chaos and high risk for lenders, insurers, everyone. These massive swings were almost always because of one or two high-value sales dominating low volumes. But the implication is real. It signals that high-net-worth buyers are entering these peripheral markets, and they are willing to pay a massive premium.
And that continues with Callahan County, up 79.2%, and Palo Pinto County, which appreciated 70.7% to $478,000.
These four counties, Stevens, Rains, Callahan, and Palo Pinto, show that the true price volatility is not in the stable metro areas. It's out in these smaller, lower volume, more rural or exurban counties.
And the opposite extreme shows why we have to be so careful. Some counties saw shocking price drops.
Yeah, and we have to put a huge small sample size alert on Shackelford County, which plummeted 92.7% to just $20,000.
That's got to be a land sale.
Almost certainly a single sale of raw land or a severely distressed property just dragging the entire monthly median down. It's an indicator of volatility, not a true market crash.
But the volatility extended to some higher volume counties too.
Absolutely. We saw major genuine drops in Nolan County, down 55.6%, Montague County down 41.2%, and Freestone County down 37.8%.
So this bipolar environment, massive appreciation here, massive drops there, is the signature of October 2025 in North Texas.
It is a market defined by whiplash.
Okay, moving beyond price, let's look at extreme sales volume. Where is demand surging most aggressively?
This metric shows exactly where buyers are landing. We saw several smaller counties experience volume booms that rivaled Jack County's YTD growth in a single month.
Like where?
Upshur County saw a massive increase of 300.0%, moving from just 2 closed sales to 8. Delta County was up 250.0%, from 2 to 7 closed sales.
These are huge percentage increases on tiny foundations, but it shows that even a small increase in demand volume can overwhelm a small market's infrastructure.
And that leads to future price pressure. We saw it with Franklin County too, up 200.0%. And again, Stevens County surged 175.0% in closed sales volume.
The signals are irrefutable.
They are. Buyers are absolutely active in these niche peripheral markets. They're searching for that elusive, available inventory that the metro centers are hoarding.
And on the flip side, which counties saw that lock-in effect really hit their volume hard?
Nolan County saw closed sales decline, a stunning 85.7%. They went from 7 sales down to just 1. Freestone County dropped 52.6%, and Limestone County fell 31.6%.
In those counties, the regional sluggishness is a massive reality.
Huge reality. It suggests deep seller frustration and that price expectation adjustments are still desperately needed.
The final volatility metric we have to look at is inventory shrinkage, or MSI. This is so crucial because it measures the current state of that supply-demand tension.
We're looking for the largest drops in MSI, indicating markets that are tightening up rapidly. Delta County saw the largest drop, 46.4%, moving from 11.2 months all the way down to 6.20 months.
That's an instant shift. Going from a deep buyer's market to perfectly balanced in 12 months. That means if you're a buyer in Delta County, the negotiating leverage you had last year is completely gone today.
And even more aggressively tight. Taylor County dropped 45.7%. It went from 4.6 months down to a very tight 2.5 months.
That's a seller's market.
That is firmly, definitively a seller's market territory. It indicates intense competition for very limited listings.
And Jack County's drop of 34.0% from 15.9 months down to 10.5 was the third largest decrease recorded.
And the takeaway there is that Jack County, despite its still high 10.5 months of supply, is following the same velocity pattern as these rapidly tightening markets.
The contraction rate is the key insight.
It is. It indicates that if buyer activity continues at this pace, that supply backlog will cease to be a factor sooner than anyone expects.
So if you were relying solely on the headlines or that regional median price, you would be wildly misinformed about what's actually happening.
The story is hyperfragmentation and nonlinear market shifts. The large metros are like a battleship, slow to turn and highly stable.
But these peripheral counties are the speedboats.
They're the speedboats. They're agile, they're fast, and when they hit turbulence, they deliver serious whiplash.
Which brings us to Section 4, deeper statistical takeaways. Let's contrast those volatile speedboats with the stability anchors, the major metro centers.
Right, let's start with Tarrant County, which is Fort Worth and its suburbs. Tarrant County is showing remarkable, almost boring stability in October.
Boring is good in real estate sometimes.
Sometimes it is. The median Vails price remains flat, 0.0% change year over year, holding precisely at $345,000.
0% change across the board is remarkable consistency.
It is. Inventory is also flat, down just 0.8%. And critically, its month supply of inventory remains flat as well, holding steady at 3.8 months.
And 3.8 months MSI is firmly a seller's market, but the 0% change across all key metrics suggests a very mature, high-functioning market.
It seems the lock-in effect here is working to stabilize supply and prevent rapid price escalation. People aren't selling, but buyers are still present enough to consume what little stock there is.
Tarrant County shows that in these high-volume, desirable areas, the market has basically reached an equilibrium. It's tight, it's stable, and it's predictable.
Dallas County follows a similar, though slightly more upward trajectory. Median sales price was slightly up, a modest 1.1%, hitting $368,950.
And inventory?
Inventory grew a bit, up 6.7%, and the MSI increased slightly to 4.9 months. So Dallas is steady, still seeing modest price appreciation, though supply is becoming a bit looser than in Tarrant.
Now, here's an intriguing contrast. Collin County, home to Plano, Frisco.
Closed sales there actually increased slightly, up 4.3% in October, which signals robust volume. However, the
Price.
median sales price is down significantly. It dropped 9.3% to $440,000.
That is a huge price dip for Collin County, a region that's historically synonymous with high growth and high value.
Sure.
What does rising volume with a sharp fall in median price imply?
It implies that transaction volume is only being maintained through significant seller concessions, or that a higher proportion of sales is happening in lower price segments.
Maybe more condos or townhomes?
Could be. But Collin County sellers are clearly having to give more to close a deal. We see that in the pricing pressure metric. Their percentage of original list price received dropped 1.5% in October.
So the demand is there, but buyers have aggressively established a lower, non-negotiable price ceiling in that high-cost market.
The days of accepting any price in Collin County are over. That is a massive takeaway for sellers there.
So this analysis confirms our thesis. The closer you get to the urban cores like Dallas and Tarrant, the more stable things become.
And the further you go out, the crazier the swings get, which leads us back to the overarching trend: rural momentum.
The data strongly confirms that migration and housing demand are favoring these fringe markets.
Yes, creating high volatility, but also powerful volume growth. These exurban counties are seeing sharp spikes in median sales price and increased closed sales.
Give us a textbook example.
Jones County is a perfect illustration of a market that has successfully captured accelerating demand in 2025.
What do the metrics show?
In October, everything was up. New listings up 29.4%, pending sales up 20.0%, closed sales up 40.0%, and the median price jumped 36.6%.
And the YTD numbers?
They're just as robust. Closed sales are up 33.3% YTD, and the YTD median price is up 13.5%.
That stability and appreciation, paired with massive volume growth, it's almost the ideal scenario for a rapidly expanding market.
And it's without the high price friction we saw in Jack County's October DOM. Similarly, look at Brown County. It exhibits extreme closed sales growth, up 61.3% in October, paired with a significant median price surge of 29.8%.
And their year-to-date is also positive.
Positive and stable. YTD closed sales up 5.5% and YTD median price up 6.3%. This is a market that's heating up and successfully converting buyer interest into sustained transactions and stable price growth.
So this phenomenon confirms a critical behavioral shift among buyers. They're moving out of the stabilizing metro areas
and into these high volatility, lower cost fringe areas, searching aggressively for available inventory and relative affordability. The lock-in effect hasn't killed demand, it has simply funneled it to the only places where inventory creation is still robust.
Which happens to be these low-volume rural counties.
Precisely.
That brings us to our synthesis and conclusion. For you, the learner tuning in, what is the central finding and the key strategic takeaway from this October 2025 deep dive?
The central finding is market bifurcation and volatility. The overall North Texas market shows signs of price softness, declining sales volume, and slower speeds.
Which is consistent with the high-rate environment.
But this regional sluggishness is merely a mask, hiding these intense, localized hot zones defined by extreme volume increases in low-volume rural counties.
And Jack County is the perfect microcosm of this entire trend. Let's just reiterate the key metric that defines its powerful counter-regional trajectory.
It is the inventory absorption velocity, the significance of the 34.0% drop in months' supply of inventory in Jack County. It cannot be overstated.
And that rate of change, coupled with the explosive year-to-date closed sales growth of 44.2%.
It indicates powerful underlying demand momentum that has been consistently building all year.
And that momentum is forcing inventory off the market at a rate that is just unsustainable for supply. This is despite that counterintuitive metric of the days on market spiking to 111 days.
Right, and we concluded that friction is likely caused by aggressive initial listing prices, forcing that protracted price discovery.
So the key strategic takeaway for anyone involved in North Texas real estate right now is simple.
You must look beyond the regional $360,000 median sales price. That number is deceptive, and it's irrelevant to local market strategy. You have to focus entirely on hyper-local inventory dynamics.
Because in these low-volume counties, small changes in the supply-demand ratio lead to massive, non-linear volatility.
That is where the opportunity and the risk is concentrated.
So if you are an investor looking at Tarrant County stability, Jack County's 44% sales growth is like a siren call.
But that 111 DOM should look like a massive red flag that demands caution regarding listing prices. It forces a different type of risk analysis.
Are you seeking stability or are you chasing explosive velocity?
It's truly a world of micromarkets now. The stability lies in the major metros, but the highest growth potential is squarely in the fringe.
Which raises a powerful final question for our listener to chew on after this.
Given the dramatic inventory decline in markets like Jack County, and considering the extreme price swings we highlighted in Stevens, Rains, and Palo Pinto counties,
Does the October 2025 data signal a fundamental return to the explosive, nonlinear growth patterns we saw in the peak boom years of 2021 and 2022?
but this time is that growth confined specifically to these specialized rural and exurban pockets. In other words, is the lock-in effect, which is depressing listings in the metros, simultaneously pushing buyers who are desperate for inventory into these high-volatility, lower-volume fringe markets.
Creating localized boom cycles even while the larger metropolitan areas stabilize.
It suggests that high interest rates didn't eliminate the underlying demand pressure from regional growth. They just redirected that pressure to the only places where inventory is still available.
Even if that inventory comes with extreme price uncertainty.
A fascinating redirection of market energy that requires buyers and sellers to be more informed than ever before.
That's all the time we have for this deep dive into the non-uniform reality of North Texas real estate. We hope you walk away well-informed and ready to tackle those county reports yourself.
Until next time.